Hello, and welcome to this month's View from the Lighthouse. I am David Hansford, Executive Director and Portfolio Manager at Long Beach Capital, and in today's episode, we will take a break from our regular market commentary and chat about tax-free savings accounts, TFSA, how they work, and their key benefits to investors, and why they are an important tool for long-term savings. Planning your financial future means understanding the investment options available to help grow your wealth tax effectively. In South Africa, the tax-free savings account, TFSA, is a flexible and highly tax-efficient option for building savings. This guide explains what a TFSA is, the key benefits, and why a TFSA is an essential tool for investors looking for smart tax-free savings solutions. What is a tax-free savings account, TFSA, in South Africa? A TFSA is a government-approved tax-free savings account designed to encourage savings and help investors grow their money tax-free. Earnings from interest, dividends, and capital gains within a TFSA are exempt from income tax, dividend tax, and capital gains tax. This tax-exempt status significantly enhances the growth potential of your investments by allowing returns to compound tax-free. What a TFSA can be used for. The TFSA account serves as a flexible savings option suitable for a wide range of financial goals, from building an emergency fund to saving for a child's education or growing long-term wealth. A TFSA offers penalty-free withdrawals at any time, combining tax efficiency with liquidity, key features of a tax-free savings account in South Africa. Contribution limits. Annual contributions of up to 36,000 Rand per tax year, March 1st to February 28th or 29th. Lifetime contribution cap of 500,000 Rand. Withdrawals do not reset contribution limits, so withdrawn amounts cannot be recontributed in the same or future years. Tax benefits. All capital gains, interest and dividends inside a TFSA are tax-free. Withdrawals are tax-free. Accessibility and flexibility. Funds can be withdrawn from a TFSA at any time without penalties or tax consequences. TFSA accounts can be transferred between financial providers without affecting contribution limits or incurring tax penalties. Accounts for children. TFSAs may be opened for minors under a guardian or parent's name. This allows children to benefit from tax-free compounded growth over many years, building a solid, tax-efficient savings foundation. How does a tax-free savings account work in practice? A tax-free savings account is held with a financial institution or investment manager, offering a range of investment choices such as unit trusts, shares, bonds, or ETFs. Investing in Long Beach funds through a TFSA. The Long Beach funds both provide a TFSA option with an identical fee structure and terms to ordinary investment accounts. The ability to withdraw funds flexibly without penalties remains intact. Investments grow tax-free, maximizing long-term compounding and growth potential. How to maximize your tax-free savings account benefits. Make regular contributions each year. Consistency is key when it comes to building wealth through a TFSA. Either contribute regularly, whether monthly or quarterly, to benefit from Rand cost averaging, which can help to smooth out the impact of market fluctuations over time, or contribute the annually amount allowed on 1st March to maximize the time your investment has to compound each year. Start investing early to harness tax-free compound growth. The true power of a TFSA lies in its ability to allow your investments to grow, and without being reduced by taxes. The earlier you start investing, the more time your returns have to compound tax-free, resulting in exponential growth over the long term. Avoid unnecessary withdrawals to maximize compounding. While TFSA withdrawals are flexible and tax-free, frequent or early withdrawals can reduce your potential investment growth, as withdrawn amounts do not reset your contribution limits. Keeping funds invested allows you to benefit fully from the tax-free compounding effect. Common mistakes to avoid with your TFSA account. Over-contributing beyond annual or lifetime limits, over-contributing more than the allowed 36,000 Rand per tax year or exceeding the 500,000 Rand lifetime limit can lead to penalties from SARS, including a 40% tax on any excess amounts. Prescient Fund Services will keep track of all your contributions to a Long Beach TFSA, while it is also crucial to keep careful track of all your contributions across different accounts and providers to avoid costly errors. Treating a TFSA as a short-term savings account, TFSAs offer flexibility with penalty-free withdrawals, although using them as a short-term holding place for cash misses out on their full potential. Because of the tax-free growth benefits, TFSAs are best used as part of a long-term investment strategy with a diversified portfolio tailored to your financial goals. How Long Beach supports TFSA investors. Focused on long-term growth and risk management, Long Beach's funds are carefully structured to deliver long-term growth while actively managing investment risks. This approach ensures that investors in a Long Beach TFSA can build their wealth through maximizing long-term compound growth. Dedicated fee class for TFSA investors. Long Beach offers a separate fee class, A3, exclusively for TFSA accounts. This helps investors to clearly distinguish their TFSA investments from their ordinary investment accounts within the same fund, simplifying portfolio tracking and administration. Accessible through trusted platforms, investors can open and manage a TFSA with Long Beach via Prescient, Glacier, Momentum, and 91, answering frequently asked questions about tax-free savings accounts. Can I contribute to multiple TFSAs with different providers? Yes, you can open multiple TFSAs with different financial institutions or providers. However, it is crucial to remember that your total contributions across all your TFSA accounts combined cannot exceed the annual contribution limit of 36,000 Rand per tax year or the lifetime cap of 500,000 Rand. What happens if I accidentally exceed the contribution limits? If you contribute more than the permitted annual or lifetime limits, SARS will charge a 40% penalty tax on the excess contributions. This penalty applies each year that the excess amount remains in your TFSA. Additionally, interest on the unpaid penalty tax may also be levied. If you realize you have overcontributed, it is advisable to act quickly by withdrawing the excess amounts to minimize penalties and then consult with your financial advisor or tax professional for guidance. Can I open a TFSA if I'm not a South African resident? Generally, only South African residents with a valid South African ID number are eligible to open a TFSA. Non-residents or foreigners typically cannot open a TFSA. Are there restrictions on the types of investments inside a TFSA? Yes. While the TFSA itself is a tax wrapper rather than an investment product, the types of investments you can hold within your TFSA depend on the financial institution or platform managing your account. Most providers allow a broad range of assets, including unit trusts and mutual funds, exchange-traded funds, ETFs, bonds and fixed income securities, individual listed shares, money market funds. To get started on your TFSA with Long Beach, visit our website and either apply online or download and complete an TFSA application form. Thank you for listening. Join me again next month for another view from the Lighthouse.